Join us today as we answer the question, do I have to make my loan payments and make my premium payments?
Enjoy the episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And like I mentioned today, what we're going to be talking about is, do you have to make your loan repayments and continue to make your premiums?
Which, I think we could answer that very simply with a yes or no.
Yeah.
But then the podcast would be over. But what we want, we just don't want to have the answer. We want people to understand the answer and why.
Yeah.
So we're going to go in to understand both sides, right? And as we get into it, well, first, let's clarify what's the difference between a premium and a loan repayment. Okay. Cameron, what would you say?
Oh, good question. So there are two different pieces to kind of this same process. So let's break them out. What I would say is the premium payment, this is the part that is the systematic savings piece to what you're doing. So this is the habit. Hey, I'm going to save X number of dollars on a monthly basis or an annual basis. And that is the premium that goes in to capitalize and fund the policy payment on any given year. Right? So as Nelson would say, is don't be afraid to capitalize. We want to be able to save, till it hurts, right? This should this should be a percentage of your income, right? 20% or more would be ideal. This is what we're going to be putting away every single year. And that's the habit. That's habitual, systematic savings that we have every year. That's the premium.
Okay. Yeah. So let's talk about a loan repayment.
Completely different step in this process. A loan repayment or loan, right, is actually when we're going to leverage against the cash value that we built up in the policy to go make some sort of investment. And the loan repayment is how we get the money back in the policy. And so if we're looking at taking a loan to invest, number one is we always want to invest in what we know, right? Whatever industry we're in, whatever we've been successful at, that's what we want to look at. Number two is there's also a level of due diligence that needs to be done before we make that investment. One of the things that we always tell people is that, hey, listen, there's an equation to everything, whether it's real estate or business. If we can calculate A plus B and C is a very high likelihood that we have this outcome, great. We got to go figure that out before we go and make any sort of investment. The last thing I'd say here on this part of it is that loan repayment, right? If we make that investment into some sort of asset, that asset needs to create some sort of cash flow for us. Whether that's monthly, quarterly, annually, we've got to have some sort of cash flow that comes off of that. And that cash flow not only needs to satisfy the loan interest that we're going to be paying the insurance company, right? But it also needs to produce some sort of yield for us above and beyond that.
Well, Cameron, let's say, for example, somebody's doing an investment where it's not producing, say, cash flow every month. Maybe they're flipping a property or it's a buy and hold deal, and maybe they're not going to be able to receive money for, say, a year and a half or two.
Great question. We get this often, and what I tell clients is I say, you're going to let the asset that you invest in dictate the loan repayment. So if somebody's out there flipping, typically money's outstanding from anywhere from 4 to maybe 6 months. And so what we do is we don't need to make any sort of loan repayments or any interest payments in those 4 months. But when we sell that property and we get the proceeds and the profit from it, now what we can do is we can put that back into the policy along with paying off the loan interest.
Okay, perfect.
Yeah, absolutely. Now, Anthony, Nelson also gives us some guidance, right? Anytime we're faced with some sort of question on infinite banking, let's go back to what Nelson said. And Nelson often said that we should think like a banker. Can you give us some CPA wisdom, some insight to what he means there?
For you, Cameron, I'll gladly share my CPA wisdom.
Thanks.
What Nelson often talked about is you're in two businesses. The one you make a living and the banking business. What most people do, they outsource the banking business where they're using somebody else's bank and they're never seeing all of that money or that income. And what he's trying to teach people to do is that you can create your own banking system. Thus, his book is called Becoming Your Own Banker. Right? Now, if we start so he wants us to think like a banker, right? And to now if we have infinite banking, we have our own banking system. So we need to be thinking like a banker. And bankers think very different, right? And for example, Cameron, for most people, would they view a loan as an asset or a liability?
Most people view it as a liability.
Right? But most people would. The consumer would.
Mm-hmm.
But what is it to the banker?
It's an asset.
Because that's money being the bank is receiving the money, so it's an asset.
Mm-hmm.
So we want to try to wrap your head around is let's start thinking like a banker,
Mm-hmm.
right? And so let's not be so scared about the word debt or loan, right? Because we got to think like a banker that loan is an asset. Right? Now, I might even argue that a policy loan would be a double asset.
A double asset?
Double asset.
Did you just make that up now?
I did.
Please
Let's
enlighten us on what a double asset is.
Well, really, I've been studying this and working on how to explain this for a while. No, but as we were preparing for this, I'm thinking, well, if it's an asset,
Mm-hmm.
For a banker, but the way that I view my policy loans is that they're an asset because I'm leveraging my money to create the loans to create more assets.
Mm-hmm.
And typically those assets are repaying the loan, not myself.
Okay.
And also when I look at a policy loan, I don't pay off all my policy loans. I want to have a place to store some cash in the future. So if I pay off all the loans, then I might need to start a new policy later. But what I will do is before my policy loans get too low, instead of paying them off, that's a sign to start another policy. So, I don't even know if we answered the question yet. Do you need to pay the loan repayments and your premiums? If you start thinking like a banker, Cameron, what would an honest banker do?
You'd make the loan repayment.
Yeah, we got to do both.
Yeah.
We got to do both,
Yeah.
right? Go ahead.
Well, I was going to say that the point that you just shared there, I hate to give you a compliment as much as it pains me, is I would say that that's a veteran approach to kind of infinite banking, because oftentimes what I see is this question is mainly posed to, or oftentimes posed to someone that's brand new to kind of infinite banking, and it kind of comes up with the practical approach of most people when they start capitalizing their banking system, they take a loan, they're in a hurry, right, to get that paid back, or they have some sort of repayment schedule set up. And when they are buying or using those loans for some sort of liability, then it often comes up, hey, do I need to continue to make my premium, and do I need to redirect this car loan payment, right? So I liked your approach there as far as viewing it as an asset instead of a liability.
Well, thank you, Cameron. And I know there's many IBC guys and gals out there. I would say majority of them talk about using your policy to recapture expenses or to pay liabilities. Totally works for that.
Yeah.
There's no doubt. But man, it's so much more exciting to use it for assets.
Yeah.
Right? So then that policy loan, and maybe those guys aren't viewing that policy loan as a double asset because they're the one repaying it.
Yeah.
But in my policy loans, there are some that I use personally. Sometimes if I need a new air conditioner or some foreseen expense comes up, I'm going to pay for it. I mean, instead of using a credit card, I'd rather use a policy loan.
Yeah.
So I do that. But ideally, it's a lot more fun when I'm using those loans to create cash flow.
Yeah.
And those assets are repaying those loans.
Mm-hmm. Anthony, as we're talking, I was thinking I've got some calls lately from clients that, have some loans that are outstanding for certain types of investments.
Mm-hmm.
And some of those investments have not been performing very well lately. Right?
I wonder which ones are not performing right now.
So the questions, right, that I've been posed is, hey, how am I going to pay this thing back? And so that often comes up. And so, again, it's an understanding of, hey, what is a policy loan, right? If we go and we invest in something and maybe the value goes down for a period of time, well, maybe we should circle back, or maybe we could think a little bit bigger about our banking system And I had a great conversation this week. The client actually called in and brought it up and said, hey, listen, I have this asset that I took a loan out for that's not performing right now. I don't know when it's going to turn around. But you know what? I heard you guys talking about the tax issue. And he's like, I've got, a few $1,000s sitting over here that I have set aside to pay my taxes. Could I just put this money in my policy in the meantime? Absolutely, right? And so what we talked about is not writing kind of that loan off, just knowing that we still have an opportunity for that loan to kind of, or for that investment to kind of pick up and take off and have the opportunity to put it back in the policy. But in the meantime, what we're going to do is we're going to move some cash over here on the side, and we're actually going to put it in the holding account in the policy in the meantime. So great opportunity that came along this week.
So the podcast he was referring to was one about running our tax payments through a policy, but also what you reiterated to that client is the policy is a place that we're storing our cash, and oftentimes we ideally will use to repay the loan with the asset. Sometimes if we're sitting on cash, like in that example, he has cash sitting probably in a bank, probably earning next to nothing.
Yeah.
All he did was just move that money, and now he's storing in the policy. So he still has the liquidity. It's just instead of it at somebody else's bank, it's in his bank. And in essence, what he's doing is whatever that loan rate is, let's just say it's 5%. It's like he's earning 5% on that money. So great example.
Anthony, you think of any examples? You got one for us?
Yeah. I've had a case recently where we were going to do a policy, which we call the one and done, where we make a single deposit. And then he was going to use that to create a business. And, with any business, it's going to have some risk. And so he was a little hesitant on running it through a policy because he didn't want to have to repay that loan. And what he was thinking is almost like it's a double jeopardy. Okay, I do this, start this investment. Again, we're talking worst case scenario, right?
Yeah.
Which rarely happens, but it's important to plan for it.
It rarely happens, but everybody always starts there.
Yeah,
right.
yeah,
They're like,
yeah.
what if this happens? Well,
what he's thinking is, okay, let's just say it's $100,000. I do this investment of $100,000 or $10,000. It doesn't really matter how many zeros, but if I do this investment, and let's just say I lose entire money. And what he's thinking is, okay, so I just lost $100,000 here, and I still owe $100,000 against my policy.
yeah.
And that's very common thinking, and it's very similar when people get holed up with infinite banking is saying, well, so I have to pay 5% to borrow my own money. Right, that's what the point. Both of those scenarios are missing. Is we're not looking at the entire picture, right? When you take a policy loan, yes, you have to repay interest, but you're also earning interest. And a lot of times people forget that. And in this situation for this client, yes, he lost money on the investment. Yes, he has a policy loan, but he also has an asset. That policy loan is a loan against his cash value. So he's missing that one piece. And I'm like, if we do worst case scenario, you know what we can do? Instead of taking a loan, we can call the insurance company and say, you know what? Instead of taking a loan, I want you to switch that to a withdrawal. They withdraw the money, pay off the loan. Right? No interest is due. You don't need to repay the loan. But what it's costing you is we broke the compound interest curve, right? We can never repay that back, right? But let's just kind of go through some of the other scenarios. That's worst case scenario. And to be honest, what he'd be out, I don't know the number, but maybe 1,000 or 2 because there is that lost liquidity, but really small piece. But another concern he had is like, if I take that money out, what if I can't pay the interest? So ideally we'd have him, let's just pay the interest. And because you use this for an investment purpose, that interest is tax deductible. But he's like, well, what if I can't pay the interest? Well, one option is we take a policy loan to pay the interest. It's not the ideal solution, but when we're in this situation, we're not in an ideal solution, so we're going to have to use an unideal solution to solve the problem, right? So he can pay that interest. And then if and when that gets, but let's say it still never matures. You know, what we're looking at, he's going to start another business. He's going to have other windfalls. In this situation, he does have some money in an IRA or 401k that he will have access to. Or he's going to start business anyways, or he's going to start another business. So now what he's done is he created a policy in 2022 as opposed to maybe waiting in 5 years from now until he had the money. And what he's done is he's compounded from 2022 as opposed to starting compounding from 2025. And, you know, what Nelson talks about is you finance everything you buy.
Mm-hmm.
You either pay cash and give up interest, or you finance and pay interest. So either way, that money is going to go to that business, but just like we talked about with Rewards Credit Card, we're going to get that extra bonuses.
Well said. So let's summarize this.
Okay.
Right? So, Anthony, do we have to make a policy loan, to make a loan repayment and make a premium at the same time?
What I would say is we should.
Mm-hmm.
Right? So maybe it's not a yes or no. You should eventually.
Yeah.
Is that a good political answer? Or I didn't quite answer it, but kind of did.
That was a good answer. I'm going to answer it.
Yeah.
Thanks for asking. Premium payments, right? That's our savings. That's what needs to go in the policy every month, every year, regardless. That's our capitalization. The loan repayments, right, is I'm going to tell you that, hey, if we're making the loan repayments, something's wrong, right? You and I talked about this earlier. Ideally, what Anthony and I are talking about is buying investments using the policy as collateral, and that investment should be paying the policy loan back. I'm personally not a big fan of using it for expenses, and so if we're in that scenario, right, maybe we should have rethought what we're using it for. That's my 2 cents. Yeah.
Good point.
Awesome. Great. Hope you guys learned something, right? We covered that topic, gave you a couple of examples, and hope you enjoyed the episode.
Make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.